Hello, welcome to the 1010 Book Club. My name is Billy Chan. Today I'm going to be your host for this book club sharing session. How can you avoid being a bad investor? Today you are going to learn from Peter Lim. He is an award-winning fund manager, and I want you to learn this a little bit from Peter and how can you be an informed and a better investor than where you was before. This is a very good discussion that I have had with Peter Lim, and I believe that you will really learn a bit more, and I will encourage you to listen throughout this session. This is split on the first session where Peter will share a lot of his thought through a 30 minutes kind of download to you, and then for the rest of the times it's much more like Q&A, which have answered a lot of fantastic questions from the session that we have organized. Alright, listen to the end and drop your comment below. If you have any, we will answer that for you.
Okay, actually I get to know Peter by reading his book. What I learned as an analyst, if you have not read this, I will encourage you to buy it from a popular bookstore like NPH. I think Popular will have it as well. And if not, you can reach out to Peter also. So this book is one of the easy book reading that Peter will say, if you throw it to primary school students and then they read it, if you have a small children that you wanted them to learn a bit more about how to read financial statements, how do you read about a company, so you give them this book, I believe that they will know how to learn something from it. You know, this is like a shortcut of fundamental analysis. If you compare to the old school, I think this is the Grandmaster book from Benjamin Graham, Security Analyst. This is like Camus Day One, right? So I think this is the Camus Day One. You can get probably a gist of fundamental if you're just starting out. Buy Peter's book and you can read a bit more. Let me introduce a bit about Peter. So Peter, he is I have a note here, but it dropped. Okay. Peter he is an equity investor, started on 2003, and he was an analyst before, a fund analyst. So analyst is like the people who analyze on the company. It's not a trader, right? So it's the analyst on the company. He was a fund manager, head of equity, and CEO of some local and foreign asset management in Malaysia. I think above all, I think recently I saw in Peter's Facebook as well. So he involved a lot, not just say involve himself and participate, but really spend the energy, time and money into it, doing social work with KMSSG Charitable Society. This is called Kriyalashmi Mandya Sri Sai Gurukul. So Peter, you can correct me if I get wrong with that. So it is not where the charity go, but I think for the good cause. All right. So this is a short introduction about Peter and what he's doing. So without further ado, Peter, I want to pass it to you. Let me know if you have anything to add for your own introduction, because if I want to state it a lengthy way, I need to spend like 10 to 15 minutes. But you go ahead, Peter.
Thanks, Billy. Oh, I can't help but to laugh when the part where you mentioned you can actually zoom into HD. So I don't think anybody wants to see my face in HD. Right? I can't help but to laugh when you mentioned that. Good morning, guys. Thank you for joining in. I'm trying to make this session as interactive as possible. So let me start with some presentation, and I assure you there's not going to be a lot of lengthy words and things like that. Though I must apologize, I am not as fierce as I look, right? I may look dead serious, I may look stern, but I can assure you I can be quite a friendly person. Yeah, so don't be deceived by my look. I'm just born this way, you know. So yeah. So if I want to start with my presentation, let me try this. Okay. The screen is up, right? All right.
Yes, Peter, I can see it.
Okay.
Yep.
Again, I must disclaim the title has totally nothing to do with me. It was due to Billy and his creative team. So I will disclaim myself to any any liabilities from the title. Yeah, but it's very well done. So I need to thank Billy and his team for the title. Let's go on to investment, where is all this topic about, right? You see, if you ask anyone who has invested, everybody will tell a very simple mantra. I say, hey, what is the success to investment? Be it invest in stock market or be it invest in properties or anything. A very standard answer people will say is buy low, sell high. Right? I mean, it sounds so easy. It's very easy. You just buy anything low and sell it high. So I have a favorite story, which I call it as the toilet roll story. Okay, how the story goes is that, for those who have been buying toilet rolls, especially those who have been snatching all the toilet rolls with the first MCO, you see, that's a very standard brand, say QT Compact. I think one pack of QT Compact plus minus should be around 10 ringgit. So look at it, assuming that you are a very normal consumer, you know the price is 10 ringgit. Say wherever you go to Tesco or you go to Giant, you actually buy one pack of QT Compact, and then you actually maybe buy one pack you can use for 2-3 months, right? So it's a very standard practice where every time you know QT Compact, you know it well, you know the brand, you know the price. So whenever you just go to Giant, then you just grab it and go and pay, and then you repeat the same cycle every 3 months. Now, what if assuming one day Giant gave a discount to QT Compact? So other than 10 ringgit for a pack, now they're actually selling QT Compact for 8 ringgit a pack. Now you ask yourself this question, right? As a normal consumer, what will you do? Right? So when you saw the 8 ringgit, you said, well, might as well I grab 2 packs. Since it's cheap. So you buy 2 packs rather than instead of packs. So you actually buy more when it's cheap. 1 week later, then suddenly Giant gave mega sales, mega clearance of QT Compact. All must go sales, and they start to sell the QT Compact for 6 ringgit a pack. Okay, now again, ask yourself, what will be your normal reaction? I think a normal reaction for a normal consumer is, I think they will take a trolley and buy up as many packs as possible. Maybe it can last them for another 6 months or even a year, and that's it. That's what they do. So this is a very rational psychology, right? So what's very interesting is, let's play a game. What if I change the name? Exactly the same scenario, but I don't call it QT Compact. I call it Maybank. So now, assuming you're an investor, you start to invest in Maybank at 10 ringgit per share. Right? So you bought into it. You bought, say, one lot of Maybank at 10 ringgit. So 1 week later, suddenly Maybank share price fell to 8 ringgit. Okay, now ask yourself, what would you do? Would you buy, or would you start to panic? I think most of the case, as a normal investor, you start to panic. What happened, right? And then you start to call all your brokers, you start to call your remisers, you start to call all your friends. You say, hey, what happened to Maybank? Is there any news, any significant bad news that's going to happen? Then anybody say, no, I don't know what's happening, right? I don't know what's happening in Maybank. There's no news. But you're already panicked, right? You say, I already lost 20%. 1 week later down the road, Maybank share price fell down further to 6 ringgit. Now, what do? I think at that point in time, you reach a stage where you don't want to know what happened anymore. You don't want to ask anybody. Your standard reaction will be you want to sell the share. So you just, okay, forget about it. I'm selling off at 6 ringgit. You lost 4 ringgit per share. Right? And then to make the matter worse, you feel happy. You feel happy that, finally, no more nightmares, no more sleepless night, no more worries about what's happening. Okay, I lose it, 6 ringgit, you close the chapter in your life about Maybank. Then what happened is suddenly 1 week later, people start to realize there's nothing wrong with Maybank, there's no bad news, and the share price start to recover back, not only to 10 ringgit, but assuming the share shoot up to 12 ringgit. What do? I think as a normal investor, right, you get very excited, say, hey, the momentum is back, the share price movement is up, and guess what is going to happen? I think a fair chance of 80%, you end up jumping back into the Maybank and buy Maybank at 12 ringgit because the share price is recovered strongly. So what you see, the biggest challenge to an investor is themselves, is their psychology, right? In reality, investing is not difficult, or buying or investing in shares is not difficult. It is the same mindset that you use when you buy your daily items, right? On the daily consumer behavior concept, if you know an item, you use it, you're very familiar with it, the cheaper it gets, the more you buy. But unfortunately, when it comes to investing, our mind is wired very differently. We are wired the opposite direction. We tend to want to sell when it's cheap, and we tend to buy when it's more expensive. Right? So this is actually the biggest challenge faced by investors. Not only retail investors, but even professional investors, they do face the same problem. Right? So for those investors, maybe you really feel what I'm trying to say, but this is actually a very, very common problem. That's why you look at this cartoon, right? Who wants to buy when it's cheap when it comes to share price or when it comes to investing in shares? So that is one reason that we all must really keep in mind, right? Know what, be more excited when the share price of a company that you're familiar with are under correction and becomes lower. Be more fearful if the share price are going up. So it's actually a reverse mindset, right? So take it as a buy a normal, consider mindset. Yeah. Okay. The second thing about investment pitfalls, or about a common thing which investor, why they are not successful investment, is they don't know what they're buying. I mean, let's be very realistic, right? You don't know what you're buying. But we get a very common scenario where you have people who are, say, for instance, in the banking industry, they know how finance works, but somehow, rather than they try to invest in territories they're familiar with or in segment that they're very familiar with, they tend to like to invest in areas where they have no expertise. They like to invest in healthcare, which they have no idea what is it about, or they like to invest in manufacturing or whatsoever, right? And then on the other hand, you have some medical practitioners, be it doctors or anything, who actually they have the advantage in the knowledge of medical or medical industry, not to say the medical product, the medical industry, but somehow they like to invest in other sectors they are not familiar with. Like they like to invest in banking sector, they like to invest in other. So the whole idea is investment is about knowing what you buy. Okay, again, I'll give another example. Now, if we just turn back the clock, let's assume all of us are 15 years old, right? Assume back to the time when you're 13 to 15 years old, right? With all of us, we tend to like to do things adults are doing. So very typical, you have to take your father's key and try to drive the car without their knowledge. So assume now you're 15 years old, you manage to get hold of your father's car key, you try to be smart and you try to drive the car yourself, right? Let's take a probability, right? What are the chances of you banging into something in front of you or behind of you within the next 20 meters? Either you bang the front wall of your porch or you bang the gate of your house. I give you maybe close to 98% you'll bang into something within the next 20 meters, right? So fast forward now, if I would ask you back the same question, what are the chances of you now, when you're driving your car, banging into your front porch or banging into your gate within the next 20 meters? Okay, some people say, yeah, zero. I have absolutely no chance of doing that. Okay, but let's be realistic. Maybe say 98% chance you wouldn't bang into the front wall or the back gate. Right? Okay, now ask yourself this question. What is the thing that makes a difference? The thing that makes the difference is not the car technology, but the thing that makes the difference is your knowledge on how to drive. So the difference is between you knowing how to drive, that actually reduces the risk, and you not knowing how to drive give you 100% absolute risk. So the reality about investment, again, is this. They say investment is risky, and it's a very common theme. We always say that investing in stock market is risky. I like to correct that. Actually, the reality is whatever you invest is risky. The risk comes from, or the risk can only be minimized if you know what you're doing. If you know what you're investing in, you can reduce the risk substantially. You can never eliminate risk. There is no such thing as a risk-free investment in this world. Let's again, you must understand that. So if there's anybody trying to sell you some fantastic financial idea, some fantastic finance product is risk-free and guaranteed return, I guarantee you that's a con job. There is absolutely no risk-free and guaranteed return. But on the other hand, if you don't know what you're investing, you're 100% absolutely at risk. So the risk minimization, be it in any investment, is you knowing what you invest in. So what I'm trying to say, as an investor, before you invest in anything, please at least do some homework to actually know what you are investing in. Okay? The third thing I want to stress about this is, always understand this, investment is not about competition. You are not competing with anybody, right? So I always advise investors, what is the first thing you must do when you decide to invest in the stock market or invest in properties or whatsoever? the first thing you must do is not to identify which stock to buy or not to identify which property to buy. The first thing you must do is know what is your objective. That is the first thing you must do. Okay, what do I mean by that? Like for instance, some people may say, okay, I want to invest in this stock, for instance, right? And my target return is 10% per annum, or I want to earn 10% over the next 1 year. Some maybe say, okay, I want to get the target return of 15% over the next 1 year. Some could be 18.5%, some could be 17%, some could be 20%. There is nothing wrong and nothing right. Investment is really a very personal thing. It's about your personal objective. So first thing you must do is set the objective. What do you expect from the investment? And as long as you achieve your target, be happy about it. Okay, why do I need to stress this? This again is a very common problem. Let's assume that you have already set a target. Okay, I will invest in this company ABC. I intend to earn, say, for instance, 20% over the next 1 year, right? And you did invest in ABC, and over the next 12 months, ABC give you a 20% return. So by right, you should be absolutely happy, right? You know, you have achieved your target. But you know, human being human. So what generally happens is you start to look at your colleague or your neighbor or your brother, sister, or your auntie, uncle, or whatever it is, and you start to look at what they buy, and they invested in company DEF, and they're making 50% return. This is where all the problem starts. So rather than you being satisfied that you have already made your investment objective, hey, I get 20%, you start to feel very upset. And you start to blame yourself is, why do I invest in ABC and why didn't I invest in DEF? Why is it that I only get 20% return and why is it they are getting 50% return? And rather, instead of getting absolutely happy about yourself, you get absolutely upset about yourself for missing out another 50%. So look, let's get this straight. Investing is a personal objective. You're not in a race. You're not in a competition with anybody else. As long as you set your objective, you make your objective, be happy about it. If anybody earns more than you, that is their merits, that is their effort, be happy for them, right? There is no competition. I mean, so what if you earn 50%? It's not a race, right? So again, be very, very aware of this. It is something very emotional thing. You need to tune your psychological right. Okay. Next common thing I always heard about is diversification, right? Okay. Again, some people sell the idea that you need to diversify to buy into a lot of stocks to actually have a diversified portfolio. On the other hand, some people say, no, you should be focusing. You need not go into diversification, you need to focus. Okay, now, which is correct? Should you diversify or should you focus? There is a few common answers to the perspective to it. Okay, the first question you ask is how much capital you have. Say for instance, if your capital is small, say for instance, give and take, say 5 to 10,000, you can't really diversify much because if you think about it, if you want to buy into 10 stocks, each stock is 1,000 ringgit. So then ask yourself, does it make sense to diversify, right? So if you have say 1 million to invest, then by all means you want to diversify. You can diversify. So one factor consideration is how much is the capital you're talking about. The second more important thing about this is how well do you know the company you invest in? Go back to the earlier point. Okay, let's take this very simple example. Assuming there's two individuals, right? Individual A and individual B. Individual A knows extremely well about only one company. He spent his whole life just analyzing one company and knows that company 100% absolutely well. And he invested all his money into company, let's call it company A. The other individual who doesn't do any homework, who don't know what he's involved in, but he chose a diversification strategy. So he invested in 30 stocks. So he bought into 30 companies, which he absolutely don't know anything about it. He just do diversification because people say you need to diversify. So he invested in 30 stocks for not knowing what they're doing. So now my question to you is, who do you think is safer? Or who do you think has a safer portfolio? The portfolio which has company A alone, but the investor knows absolutely well what the company is about, what is it going to do, what it's doing, and the prospect, or the other portfolio which has a very diversified 30 stocks, but he knows absolutely nothing about all those companies. So again, diversification is a very easy concept to sell, or a very concept easy to tell people, but in reality, you can tell it's really not practical. I've met a lot of self-made successful investors. Honestly, my career, I've met with school teachers who actually after retired, they start to invest themselves and they did very, very well. I've known banking officers. I mean, as in the banking club people, they are really banking officers, right? They started as an officer and they actually learned investment themselves, and now they're doing very well. Various people from all walks of life, right, who have actually done quite well in investment for themselves. And I noticed there's a very common characteristic. They may have a lot of portfolios, a lot of stocks in their portfolio, but ultimately when you analyze, right, what actually helped them in the long run, it usually boils down to only less than 5 companies. So in the end, there's only less than 5 companies on average that's actually helping them to be successful in building a retirement. So it is not as in, so the whole thing about investing is it doesn't matter how many stocks you have. So don't have the mindset that you need to have 20 stocks to be successful. You need to have 30 stocks to be successful, or so on and so forth. It doesn't work that way. As long as you know what investing in reality, it only takes 1 or 2 stocks to be successful. Let's take the early book that Billy mentioned earlier, right? Security Analysis by Benjamin Graham. If you track Benjamin Graham's history, technically, there's only 1 stock that gave him the return that equivalent to all the investment that he ever made. There's only 1 single stock. That actually was the defining moment for him. So again, don't diversify for the sake of diversification. It doesn't matter how many stocks you have. What is more important is, do you know what you invested in? Yeah. Okay, now, this is going to be my last slide. Okay. For any investors, investment analysis, or to understand a company, it may sound like rocket science. It may sound it's very complicated that, this is a job of the investment analyst out there. It's a very finance-heavy thing to do. I'm very bad with maths. I'm very bad with numbers, so on and so forth, right? So it make it sound like very rocket science. But I can tell in reality, investment analysis is actually very, very basic. It's something very, very simple. In the end, I always explain to people, you're only trying to answer 3 questions. That's it, only 3 questions. The first question you want to answer is it a good business? Okay, what this simply means is you must look at the industry. Is it something that you like? Like for instance, right, you guys are from semiconductor. So you must ask, do you still believe in semiconductor industry? Right? Do you think that there's still a future in semiconductor industries? Do you think that IC chip is going to die? Do you think that the processors is on the downtrend? So on and so forth. Okay, so if your answer is no, I don't like the business, then stay away from the industry. But if you think that, okay, I think that this industry has a very good future due to all the automation that's happening, all the digitalization that's happening, all the so-called the high-speed data that's coming up with all the cloud storage that's coming up, the need for all the data centers. So that actually answers your first question. Is it a good business? Okay, now, so after you cross that first hurdle, yes, you like this business, then come to the second question. Is it a good company? So what this basically means is, so now you've identified you like semiconductor industry, for instance, right? Now the next question is, which company that you think that is going to do very well over the next 3 to 5 years in this industry? Is it going to be a company like NVIDIA? Is it going to be a company like Teradyne? Is it going to be companies like Intel? Is it going to be AMD? So on and so forth. Or is it going to be Sony? Things like that. So then you start to see within all this industry, which company that you like, or which company you think that is very well managed, has a very good product pipeline, or have the right technology to position themselves to be the industry leader over the next 3 to 5 years. Okay. So that is the second question. Now, the third question, which is actually the most difficult question to answer, I call it how much you're willing to pay for it. Okay, this is actually what I call as a layman term for, we always call it valuation. When I talk about analysts, right, they always say valuation, what is your target price? But rather than make it so complicated, you ask yourself this question, how much you're willing to pay for it? Okay, what it simply means is, after you fulfill your first question, is it a good business? Yes, I like the semiconductor industry. Second, is it a good company? Say, for instance, Intel. You say, yes, I like Intel. I think it got a good product pipeline that is going to be successful. The next question is this. At the current share price, after doing all your homework, would you invest at the current share price? So this is what you mean by how much you're willing to pay for it. So be in any company that you intend to invest, run through these 3 questions yourself. Then ultimately you'll find an answer whether is that company that you wish to invest, is it something that is worth for you to invest in or not? Billy, I think that is my last slide.
Right. Peter, thanks for going through this. I think for those that joining us late, right? So we are going to spend the rest of the time answering your question. I think this is intended by Peter that say that, hey, we wanted to make sure that rather than share random things, there's a few people that beginner, intermediate, or advanced, you can ask any question that you want. And bear in mind also, this session will be recorded and we are going to post it in YouTube later on so that people who miss it can rewatch it also. Okay. Open up for question from everyone. And before that, Peter, I think you want to hit sharp on your last point, right? I think number one, number two is fairly easy because emotion are not really attached to that one. But how much are you willing? I think that is very emotional for me to make the choice whether is it or not. How to stabilize my emotional? I think that will start the question for you. How am I able to stabilize my emotion in order to see what is the price that I'm going to pay?
I think it can be emotional and it can also be not emotional. Okay, I used to tell this story. Say every day before you go to work, there is this bakery that you love it very much. So every morning before you come to work, you actually go to the bakery, grab your favorite bread or croissant, and then come to work. So imagine now this is a scenario. So one day the owner came and talked to you. He said, hey, no, unfortunately, I need to migrate to Australia or New Zealand, right? So I need to give up this business. I need to find a buyer for it. Would you be willing to buy? And then with utmost honesty, the bakery owner told you that this bakery is making 1 million profit every year. Good times, bad times, every year is making 1 million profit. Okay, now, what I usually do this exercise in the live session is I ask them this very basic question. Now, assuming with this information, how much would you want to offer to the bakery owner to buy over the bakery? Okay, what is your number? Okay, usually I get wide range of answers. Some say I will pay 500,000. Some will say I'll pay 1 million. Some will say I won't buy. Some will say I'll pay 3 million. And the highest so far I've gotten was 5 million. Right. So then the question is, who is right? Is it 300,000, 500,000, 1 million, 2 million, 3 million? And my standard answer is actually this. The real answer is everybody's right. Nobody's wrong. See, that's exactly what it means, right? Because everybody will have a different valuation or a different willingness to pay for a business. For those that they don't like bakery that much, they say, yeah, I know I'm making 1 million a year, but maybe it's not a business that I like a lot, or it's not a business that I understand how it works. So for me, I'm only willing to pay you 500,000 for it or even 1 million for it. But on the other hand, there are some people who actually understand the bakery business and they love the business. They said, well, I think I can make it grow bigger. I love the business, and they may even will pay 3 to 5 million for it. So this is what I mean, how much you're willing to pay for it. But in the end, really, who is right and who is wrong, it's really nothing much about who is right and who is wrong. Ultimately, whether you're right or you're wrong will be justified by the subsequent performance of the company and the performance share price. That's it. But then again, remember, I said investment is not about competition. So even if you don't buy this bakery, you buy something else and you make money from it, it's good for you.
Hey, Peter.
Yeah.
Hey, Peter. Peter, can I ask a question?
Yeah, go ahead.
I'm CE here. Yeah, and referring to your last slide, right, when you talk about to know whether it's a good company, can you share more about how to know whether that is a good company? Because for people like us, right, we are a retailer, investor. A lot of time we read the kind of a report and then interview of that the how to say the management team of the company, right? This is the easiest way we know them, right? We don't have the insight, right? And then we know, right, a lot of good company is determined by the people who run the company, right? But when in the interview, right, we read through this maybe the CEO, the founder, right, talk big about the company, right? But eventually, right, the kind of talk big doesn't mean the deliver big result, right? So how a retailer can know whether how this is a good company?
That's actually a very, very good question. Okay, when you say how do you decide on the question two, is it a good company? You must look at two perspectives. First aspect is quantitative. Quantitative actually means you have to look through the financial deliveries of company. How has the company performed in the long run? So I explain to you, when you read annual reports, when you look at historical performance, I advise people to go as long as possible. Don't take a shortcut. You just look at, okay, what is the last 2 years' performance? Last 2 years' performance, then you think it's good. It doesn't work that way. You have to go at least minimum, my advice is 5 years. You look at how the company has been performing over the last 5 years or more. If you go up to 15 years or 10 years, it's even much better. So the first way to track is, how has this company performed over the last 10 to 15 years on the long run? Has the revenue been growing slowly, or has the company earnings been very volatile or is dropping? So the first measurement is quantitative factors, where you look at historical performance. How is the profit business margin like? Is this company margin higher than the competitors, or is this company's margin significantly lower than the competitors? So if the margin is higher than what the industry is making, then know that there is something that they're doing right, they're doing well. But if the company's margin is consistently lower than other people, then is something wrong. Balance sheet. Is this company highly geared, or this company that has a lot of cash reserve? Highly geared companies are technically more at risk than companies with good cash reserve. So these are all the quantitative things where you can look at the historical number to actually justify. But that's only half the story. The other half of the story, which you point very correctly, is actually the qualitative aspect, which is actually, I sum up the sentence, do you trust the management? So how does the management behave in that sense, right? A good way to judge is look at during times of crisis, how do they manage the business? What is their characteristic? Do they drive around in fancy cars? Is their lifestyle like a celebrity lifestyle? When you go to a factory visit, you see a fleet of fancy sports cars there that's under the company's name. These are where it's more of a qualitative factors. See, the reality is that's very realistic. In all media interviews, right, nobody will say bad things about themselves. They will say good things, no, I'm going to be very, very big. Then again, you must track back also. Look at all the past comments that they make. Did they subsequently deliver those very optimistic views? If after 1-2 times you notice they come to media, they say fantastic things, but subsequently they fail to deliver, that will actually give you a very good indication of how reliable or how trustworthy this management is. Right? So 2 aspects, quantitative aspect and qualitative aspect. I hope I answered your question.
Yeah, thanks a lot, Peter. Yep.
Yeah, welcome.
Peter, there's a few coming in from the IM, right? Let me read to you. So, how did you start your career? When or how did you know that you would like to start or continue a career in finance from Abby?
Oh, this is actually interesting. I got into this industry purely by accident. I'm an accounting graduate way back in 2003. So as with all accounting, right, you just go to audit firms. So okay, I went to audit firm. I still remember the first day when I went to my audit firm. In the first 10 minutes, I regretted my decision. My first day, 10 minutes, I know I got into the wrong industry. So over the next 2 months in the audit firm, I just applied for anything that comes into my, this 2003, right? There's no broadband. So you still rely a lot on classified. You just buy newspaper, you just click on the classified to look for a job. And you apply doing print out A4 resumes, put in the brown envelope and mail it, right? So I was busy mailing out everything in the next 2 months. I mailed to human resource, I applied for human resource job, marketing job, internal audit job, and anything you come about just to get me out of audit. So one day I saw this very small advertisement about this company called iCapital or Capital Dynamics. I mean, for those who know Tan Teng Bu. So I know what they do. So I said anything goes, right? So I just applied. So surprisingly, 2 days later, I actually got a call for interview. It's quite funny, I'm quite a candid seller. So I still remember he asked me 2 questions on my first interview. He said, have you heard about us? I said, no, I don't know. I haven't heard about you. Do you know what we do? I said, don't know. I don't know what you're doing. So I just applied to get out of audit. But surprisingly, I got the job. And that's how accidentally I got into this thing called investment analysis. It was never planned. But I'm in this industry since then, from 2003 until now. Yeah.
Let's take 2 more from the chat, and then we go if someone live on the stage. What if I already made a wrong decision? Should I wait or do more research or press the reset button? Bracket sell from Syed Sulaiman. Yeah.
That's a very good question again. See, when you say wrong decision, you must also understand what do you mean by a wrong decision. There's a lot of type of wrong decision. Okay, let's take the first type of wrong decision. The first type is wrong decision as in that company has no fundamental, there's no prospect, and you got in wrongly because of following news flow or your neighbor recommended you or anything. So those wrong is honestly is wrong. In a sense, wrong business, wrong company, wrong prospect, wrong. Usually advice is switch. I mean, if you can find something else to switch out of it, you can just switch out of it. But on the timing, when you switch it, I mean, that one I don't know. Most of the time, it always happens after you sell, the share price will go up. So that one, life being life, right? But it's wrong. You have to make a painful decision. No, you have to really exit. I always make this joke. See, everybody talk about long-term investing, right? I'm a long-term investor. Everybody will comment and say, hey, I'm a long-term investor. But what they don't realize is there's two types of long-term investors. One type of long-term investor is long-term investor by choice. Means you deliberately buy and hold it for the long term. The other type of long-term investor is by force. You got no choice but be a long-term investor. So never fall into the second category where you're being a long-term investor by force. Okay. The second type of wrong investment is, it is a good company, the prospect is still good, but you're only wrong in terms of timing. Mean to say they're bought at the peak of the price. So then you have to reassess how high is it that the price is there from where the price is now. Again, it's something very subjective. But if your wrong, so-called wrong, is more on the share price that you bought at a higher cost, and not because the company fundamental is very bad, then maybe you can hold it a bit longer, need not make the decision to cut loss. So again, the answer of wrong decision depends on what kind of wrong decision you're talking about. I hope I answered that.
One for Lian Ping, and then we move on. For valuation of stocks is based on PE that is calculated by previous earning? Question mark. I mean, I will get it. Like, is it based on the price per earning itself, based on the historical result?
That is a very good point. Okay, if you look at in my book, actually, I have a chapter on PE valuation, right? See, PE of price to earnings means you use the price divided by the earnings. There is technically a few categories or few types of PE. The first type of PE we call it a trading PE, or called a historical PE. Mean to say, you take historical earnings, means earnings that have already been delivered over the last 12 months. You measure your PE based on that. So we call that historical PE. The other type of PE we call it forward PE. Mean to say, you forecast next year's earnings and you use that earnings to derive your PE. So be very careful about what PE you're talking about. You're absolutely right. Because whether you're talking about historical PE and forward PE are totally different things, because historical PE is the actual PE because the earnings have already materialized. But when you talk about future PE, you're talking about future earnings, which the earnings may or may not materialize because your earnings forecast could be too high and that could be due to disappointment. So yeah, there are two types of PE, but there's another type which is called PEG, which is price to earnings growth. That one is a bit hard to explain, but it's actually explained in the book. You all can actually have a look. But to answer, yes, there's two types of PE. Be careful about what PE you're talking about.
Open up for question, anyone? Unmute yourself.
Hi, Peter.
Yeah, go ahead.
This is Madhu here. It's always generally said that for everything what we start, there should be an exit strategy. Same in trading, I buy a share and like what should be my exit strategy? How high is it just my I have an initial goal of earning 20% profit. Still, there's a trend that the company is performing really well. Should I just exit at 20% or should I still wait on so that it can simply increase to 50%? And how is the analysis behind this thing, all this thought process? That's the question I have. What will be our exit strategy? Is it just our personal goals or should we analyze much deeper?
Okay. There's technically two school of investment strategy or investment style. One is, we call them fundamental strategy. Mean to say we invest on companies with fundamentals and we go for longer term horizon. The other end of the horizon, you have what I call as the traders or technical analysis or trading style. Or being trading means you don't really care about what the company is doing. You just make your decision based on the trading, on the chart pattern, right? On the technical analysis, right? I belong to the fundamental camp. I'm very bad at technical analysis, I must admit. I always tell people this, if I were to try trading, out of 10 trades, I'll lose money on all the 9 trades. And I'm a very bad trader. So I don't do trading. So on that, I'm a pure fundamental school of thoughts. Okay, but back to your question, right? Be whether you are fundamental or technical, you make a good point. Actually, before you invested, you already have a target return that you want. Okay, for instance, you want to say, I invest in this stock, my target return is 20%. But see, investing is about discipline. Once the share price hit 20%, you sell, you make your profit, you should be happy. You shouldn't be worried about what if suddenly the share price go higher and higher and higher. That's why, remember in the earlier slide I mentioned, right? Investment is a personal objective. If you already decided on objective and you have already achieved your objective, be happy about it. Even if subsequently the share price drop 50% or share goes 60, 70%, it shouldn't affect you. It shouldn't cause you emotional unhappiness because you already made your objective.
Thank you.
I get one question from the chat. I think ED Wong, I think your question been answered earlier. This from Jilim, right? How do I get started with unit trust? Which general fund should I choose to invest with? Unit trust.
Unit trust. Okay.
What fund should we choose? Yeah.
If I can be very honest, right? I always make this joke. Unit trust. You see the name unit trust, right? It actually correctly pointed that you need trust. You really need to trust. Yeah, you need trust. So, I always tell people this. Actually, honestly, between investing yourself into shares compared with investing in your unit trust, I would think that the other option or the former is actually a better strategy because you are in control of what stocks you choose to buy. Whereas in unit trust, you really don't know what is the investment style of the fund manager or whether is he acting to your best advantage or your best interest in that sense. So honestly, if you ask me to choose for investors, which is better, investing in unit trust or investing in shares yourself, I would actually prefer that you should learn to invest in shares yourself, which is actually to me is a better option. Back to this very simple example, right? I mentioned that you did not own a lot of stocks, right? Okay, just take a very classic example, public bank, right? If you go back to 1987, which is the current Bursa Malaysia is in 1987. Of course, previously we got stock market, but it's not known as Bursa Malaysia. But the current KLSE is actually started in 1987. Not assuming this. Not in 1987, you invest 1,000 into public bank, right? You just invest in 1,000. And you've totally forgotten about it. So, I mean, that time you your stock certificate, you put in your drawer and you've totally forgotten about it, right? So now, after 32 years later, one day you open up your drawer, I got this public bank stocks. If I ask you to make a guess, how much of your 1,000 in 1987 in public bank would have grown to by now? You want to take a rough guess of how much its value is? If you do your mathematics, right? Your 1,000 in 1987, 32 years ago in public bank, by not doing anything, one single stock is worth $500,000 now. That's what I say. Don't have the notion when you invest in stocks, you need to invest in 10, 20, or 30 stocks. You don't need that. You just need get one stock that you really understand, a very good company, very well run, can deliver in the long run. You hit your jackpot.
I will skip some. Peter, that's from Tan Ken Seng, right? For the sake of asking, what is your view on APP Asia and Press BEHD?
Oh dear. I'm going to push the responsibility to the earlier question, right? Someone asking what if there's a lot of company that when the media interview them, the CEO will say fantastic story about themselves, but subsequently they fail to deliver, right? I will push this statement back to the guy who opened the question just now. I think you can get very similar example from these two companies, which says a lot of how is it. Let's be very realistic about things, right? I mean, for those who have been following these two companies, you know what I'm talking about, right? fantastic stories, fantastic headlines. When it comes to deliveries, the numbers speak for itself.
All right. From Ryan, last one, then we open up. How do you recover from heavy loss in investment?
You see, again, you must be. One important thing about investing is you must be honest with yourself. Honest with yourself in the sense, if you know you make a loss or you make a mistake, right, or you make a wrong judgment, you must be honest with yourself to admit it and make corrective action. I think most of the time, right, we don't want to admit we make a mistake. We put ourselves in a self-denial mode. We start to think that, oh no, this will be fine, this will be fine, or this is only a short correction, but the fundamental is still good. The share price will recover by itself. This is actually a very common problem. It's very difficult for humans to admit their own mistake. Let's be very realistic. But I think in investment, you need to admit your own mistake. Okay, see, investment is not linear. Okay, to remind us that investment return is not a linear relationship. Okay, what do I mean by that? Okay, a very simple example. You invest in a company at 1 ringgit, right? It lost 50%, it dropped to 50 cents. See, but now for the 50 cents to go back to your cost, not to mention making profit, just to go back to your cost, you need 100% return. You see where I'm coming from? You can lose 50%, but to recover that 50%, you need 100%. So you see, investment, there's no linear relationship. So that's why you must be very realistic. So assuming now if you lost 20%, but when you lost 20%, for you to recover back your capital, you need at least 30% return. So the earlier you admit that, okay, I made a wrong mistake, I made a wrong judgment, I'm going to do something about it, the more you can actually protect yourself from it or make it from the loss from being bigger and resulting is harder to recover back the losses. And there's always this joke about it. Right? We always ask this question, right? What do you call a company that the share price has fallen 90%? Mean to say, example, right? What do you call a company where the share price has fallen from $1 to 10 cents? Mean what do you call a company that share price has fallen 90%? So the answer to this is, it is a company where the share price has fallen 80% and still falls another 50%. So it's just like when it's 1 ringgit, right? It dropped to 20 cents. Hey, it already dropped 80%. What further risk is there? There's no more risk. I'm going to invest in 20%. I'm going to invest at 20 cents. But guess what? After invest it falls from 20 cents to 10 cents. It falls another 50%. So a stock that's fallen 90% is a stock that's fallen 80% and still falls by another 50%.
Okay, very interesting. Open up. Right, let's go for one more from Xuming. With China coming up, do you think US market is still good to invest in future? Opinion?
When you say, is China coming up?
Do you think US market is still a good invest in the future?
Okay, if you really think about it, the strength of both economies are very, very different. How should I put it? If you think about like it or not, a lot of intellectual property-based assets, right, are still very much with the US. And China is, on the other hand, they're more on services and they're more on manufacturing. So, you see, the world is going to be balanced by both. See, the world need not be, there's only one survivor. I think that the concept of that the world is going to be either US dominant or China dominant, I don't think we should focus on that notion. I think we should focus on notion where going forward, there will be two substantial superpower, economical superpowers that is going to dominate the whole world. I think that's which aspect we need to look at into the aspects. Right? See, as big as US companies are, they need the China market. And likewise, as much as big as a China, they also need US consumer spending, they also need US technology. So you can't have only one survivor in that sense, right? So I would say that both markets are still attractive. don't have the notion that it's going to be a battle where there's only one survivor. We're going to see a situation where you have both superpowers, whether they like it or not, whether they like each other or not, but they still have to coexist with each one and another.
And to follow up from Eric, US election is just ahead. I think on November. I think
tomorrow.
How would it affect US stock market and global market?
This is a very interesting point. In 2016, right, when everybody was so worried about Trump campaign at that time, so people are so curious what will happen. That was a very big turning point. You said it's either Trump or Hillary, right? The old school or the new school, right? So what's interesting was I then did the analysis in 2016. What I did was I go back to 1940. President Herbert Hoover. So what I did was from 1940. See, U.S. election is very fixed. U.S. election is once every 4 years, every November. So it's really not like Malaysia, right? You can call earlier, you can call later, you can drag, you can choose a feng shui date for it. US is fixed November every 4 years. So what happened was, what I did was, since 1940, I measured the return of the S&P every 4 years for every presidency. From Herbert Hoover, so on and so forth, Barack Obama, Clinton, Bush, and whatnot. So what you realize is, right, every 4 years from the election date until the next election date, 85% of the time, the US market or the S&P give a positive return. So for those who are like a no-brainer style of investing in the US market is, you just wait for the election day, you invest in the US S&P, and you wait for the next election day, 85% chance you make a positive return. So why do I do this is because the reality of the message is that it doesn't matter who wins, whether is it a Republican or is it Democrats. Which president actually doesn't matter, generally on historical perspective. The market will always react positively after the election in the US, and especially after 4 years, 85% of the time, the US market is actually a positive return.
That's a good sharing. And follow up from Shijun, how do you take advantage of the current COVID-19 crisis to position ourselves on good investment? Then we'll open up.
Okay. Let's be. Yeah, there's two implications of this COVID that we need to have a clear understanding. One is the short-term implication, and one is the longer-term dynamics. Right? If you talk about the short-term implication, right, or the short-term surge of businesses due to COVID, I think that segment has been overplayed, seriously overplayed. Right? I think it's not wise or advisable to look at those segments. What you should be looking at is what are the changes, long-term, more substantial changes that this COVID has brought into the industry. So that I think is a more solid perspective or a more sustainable perspective to look into. Right? What are those? For instance, let's say cloud computing aspect, digital economy aspects, digital currency aspects. So those are more sustainable long-term implications from this COVID. Right? Look at the short-term implication, like for instance, right, your PE, your PE, your face mask, your gloves. I think those are really being quite overplayed, to be very honest. So I wouldn't advise to actually venture into that segment.
Open up. Anyone have a question? Unmute yourself.
But I saw a very interesting question from M. Gopali. It's actually a very fair point. You put there that fund managers have their full-time analysts to do the analysis, whereas you are engineers and retail investors, you can't afford to dedicate your time to analyze. So is it wise to follow what the fund managers are buying? Let me give a very sad truth. It's a painful truth, but it's something very real. Look, I spent 17 years in that industry. I can tell you very honestly, right? Although most of us will think fund managers are very smart people, they know what they're doing. We think all the analysts are brilliant people, they know what they're writing. But I can tell nothing can be further from the truth. They are just like you and me, to be very, very, very honest. They are no much brilliant than you. They are not, and most of the time, to be very honest, whatever they write could also be wrong. they correct very, very wrong things, which even they themselves they don't realize. See, as a retail investor, that's what I bring up to the first point. If you guys are engineers, right, what is your advantage? Your advantage is you understand the technology industry much better than any of us. Do you really believe that people like me, an accounting background guy, can know about semicon better than you guys? Absolutely no way. But see, that is where you have a competitive advantage compared with me. So, since you're already in this segment, if now I ask you a very big question, who do you think in the semicon industry has a very good survival chance over the next 5 years and is going to do very well for the next 5 years? You all will have your answer yourself. So why not take advantage of the answer and the knowledge and invest based on that? But I said the biggest problem is we like to go to territory we're not familiar with. When somebody said glove is a fantastic investment and you know nothing about glove, you also want to jump into glove. Then another analyst is going to say, oh no, let's look about glove. Let's look at all these face mask manufacturers. They're going to do very well. You know nothing about face masks, but yet you also want to jump into face masks. So stick to your core competency. And that's it. And there's really no reason you don't know about what you're doing, right? I mean, you're in the technology sector, you're in the semicon sector. You should know much better about all these processes than anybody else. So that is your key advantage. And you should actually make your investment decision or the companies based on the inherent advantage that you have. Don't try to venture into unknown territories. Back to the same point. You don't need 10, 20 stocks to be successful in your own investment. All you need is 1, 2 stocks that you know very well, hit the jackpot.
Anyone? Unmute yourself. Right. Let me. Okay, go ahead.
I have one question. Okay, so Peter, probably how long do you keep your stock? Let's say one portfolio. Okay, if the stock price do not move for 3 months, 6 months, for the other peers in the same industry has moved 30%, 50%. So do you drop stock A and go to invest on others?
Okay. There's a few perspectives to answer your question. First question is this. Ask yourself, when you invest in this stock, what is your target holding horizon? For instance, for me, myself, when I invest in one stock, my usual target is I want to hold it for 3 years. And I'm more optimistic. My 3 years target return is 100%. Meaning to say, I expect to earn 20% every year compounded. First year, 20 but you see, when I say I aim to make 100% 3 years, I don't mean the share price must go one straight line over 3 years. My point is, as long as hold the 3 years, at the end, I will get the double of my return for the 3 years period. So if I have this strategy, to me, it doesn't matter to me whether in between the share price move or not. But that's for me. But let's assume that your target is only 3 months. So your investment horizon is 3 months. Let's say, okay, I want to get 20% return in 3 months by investing in this stock. So if after investing in 3 months, you don't get the return from the stock, then maybe you have to reassess whether should you want to continue holding these stocks or do you want to switch to another stock of a competitor? So again, there's no right answer or wrong answer. The answer lies with what is your investment style and what is your investment objective. Is your investment objective 3 months, 6 months, 9 months, 3 years? What is your target return? 20%, 30%, 40%. And what is your style? Are you a value investment fundamental or are you a trader? So the answers lie with you must understand what are all these parameters for yourself. Then you will know what is your answer.
Okay, thank you.
I hope. Okay.
Anyone? Let me read this question from Tititan. I have no idea. What is the advice on private equity investment that gives corporate terms note and preference share?
Okay. You see, to a certain extent, private equity, you must understand the whole concept of private equity is to invest in very early stage of a business to give them the funding, the boost so that they can grow fast and with the objective of you cashing out over the next 5 years or even 5, 10. Okay, there's a few terms, either it's 5 years, 7 years, or 10 years. That's actually a private equity. But you must know the business of private equity, right? If you look at the ratio, on a very optimistic scenario, I'm talking about very optimistic scenario, maybe out of 30 investments that you make, you only get 1 or 2 success. The rest of the 28 actually fail. And that's actually a very optimistic ratio. Some ratio can go up to even out of 50 investment private equity make, there's only 1 success. So private equity is something quite uncertain. I would say it's quite risky, but it's quite uncertain. You really wouldn't know, will it make or will it break? So that is why a lot of investors, when they want to invest in private equity, they want to safeguard themselves. They start to request for, okay, why not you give me a term note or give me some preference shares? Preference shares in the sense that even in the end, while I'm holding for the big break over the next 5 years, I still earn some interest out of it, or I still get some protection out of it. What is more important is not about how attractive the note is or the term notes are or how attractive the preference shares are. I think a more important is how much do you believe in the business? If the business fails, nothing can really protect you. Even your term note may not be able to protect you. Your preference shares also may not be able to protect you. Because if the business goes kaput, it goes kaput. Right? So focus more. The secondary factor is whether is the term note attractive or the preference share attractive. The more important concern is whether is the business being proposed to you, is it attractive?
I think Kitty Tan asked a question that I don't understand. Reason at once sees new method of ECF and P2P. What is the advice on pitch in, funding societies, and fundastics? Yeah, I have no idea.
These are all these are all new. What do you call those? I forgot what term I usually use for them. These are really the new, what do you call those? Digital banking or digital finance kind of products, right? If you really get to what aspect, I mean, are you coming from somebody wanting to take a loan from all these platforms, or are you something who want to invest in all these platforms, right? I will try to answer from if you are looking to invest in all these platforms. The reality is, most of these platforms are still losing money. In fact, the reality about this, a lot of internet businesses are losing money. Or this digital finance business, right? Or this new tech finance business actually losing money. It can be your stash away, it can be your MyPio, it can be your P2P or whatever style. It's a very competitive business. Actually, most of them have yet. I mean, even if you look at it, Lazada is still not making money. Your Shopee making money. What more about all these P2P platforms? So the reality is, you're looking as an investor looking at all these platforms. This is a game of who have a deeper pocket, who can actually last longer and last the next 5 to 10 years, and wait until competitors all die. That's the only time we can actually start to make some money out of it. So it's a game of who has a deeper pocket to withstand waiting for other people to collapse. But if you're expecting all these platforms to make money, as an investor, the reality is they're all still losing money.
Peter?
Hey, Peter?
Can you hear me?
Yeah, hi, yes.
My question is about the how you manage your portfolio versus the fund, right, or the capital that we are available for you to continue investing, right? So that people because we have limited the kind of fund size for retail investor. So how to manage that the fund available for that person to be able to invest anytime versus when he need, right, to invest in the kind of big macro environment or economic opportunity, but he run out of bullet. Right? How to manage and balance between the portfolio and the kind of liquidity that he's still having for continued investment.
I see. Okay, I usually advise investors this. If you need a certain amount for the next 3 years, you know that there's an obligation that you need this money for the next 3 years, be it for your children's education, be it for repaying your loan or anything. Don't ever touch that money. Don't ever use the money you next for the 3 years to invest in the stock market or invest in anything, because it's really no guarantee and there's no certainty of it. Only invest in the cash or the money that you know you wouldn't need it for the next 3 years. Okay, so that's the first advice I would give. Anything you need for the next 3 years, don't do anything to it. Just hold on to the cash. Right? That's the first thing. Second thing is, again, investment style has to be something, it has to be a discipline. You must have this discipline of say, every month put a certain amount of or allocate a certain amount for investment. So you must have that as a discipline, as a practice, right? So it's not investment about like, okay, now I got this lump sum, I invest one time, that's it, close shop, I'm not going to do anything more. It will work better. I'm not saying it doesn't work, but it will work better is if you make it into a habit that every month you actually allocate a portion of your money to invest. Okay, that's the second point. The third point you mentioned is assuming you're already fully invested, right? Then there is suddenly an opportunity come. You have no more extra cash to invest. Then what do you do? If I understand the question correctly. Okay, see, my investment style, I always stay fully invested. I mean to say, when I was managing funds, be it unit trusts, be it institutional funds, be it for clients, I usually stay invested 90%. I mean to say, if it's 1 million, I'll have 900,000 invested. I will only keep 10% cash. So my style has always been to stay invested in the market. But then when opportunity comes, what do I do? So people ask me this question, hey, you're already 90% invested, you got no more cash. So when the correction comes, you got where is your money? Okay, this is what a very common thing where people don't understand. You do switching. Switching means to say, okay, now if you see a new opportunity that comes along, the first thing you should do is reassess your portfolio. You compare this new opportunity to the one that you have existing in your portfolio. You compare between this new stock, this new company, and the existing company, which one looks better, which one is more attractive. Then, if you find that this new opportunity is more attractive than, say, company B in your portfolio, right? You switch, you sell off company B and you buy into this. So, do not think that if you're 90% invested, when correction comes, you can't do anything. In fact, when correction comes, it is the best thing to do your own portfolio restructuring, do your own review of portfolio. Do a switching of your portfolio into stocks that you have, into stocks that is even more attractive now. I hope I answered that.
Peter, before we move to Titi Tan's question, right? So can you add on what is your advice and suggestion to youngsters to start invest at young age from money?
It's a habit. See, the biggest thing I always hear people say why they don't invest, right? Okay, they say let me build up a sufficient capital first. They say okay, maybe there's this notion that okay, to invest in the stock market, I need, say for example, I need 10,000 ringgit. So they say okay, wait, let me build up 10,000 ringgit first before I start. So as their savings, right? Sometimes they reach 8,000 ringgit, suddenly they'll buy something, minus off. So it may take them 3 years or even long time before they get the 10,000 ringgit to start investing. So you have that delay of multiple periods. Okay, maybe I share my experience how I got started, right? In 2003, I started working, as I mentioned, high capital. My salary is 2004. And can you imagine, I'm from outstation, I'm from Johor. So earning 2004, stay in KL, you need to rent, you need to travel, you need to eat. There's really barely nothing left. And my salary was, I got no bonus, by the way. I was actually paid 1,004 for 2 years with no bonus at 1,004. So life was very, very difficult. But I make it a point for myself is I must invest at least a little money. So what I did was, every month I invest 200 ringgit. So it looks very stupid in a sense. See, you invest 200 ringgit, your brokerage rate is 12 ringgit. So people say, hey, that's a very stupid thing to do. Out of 200 ringgit, you pay 6% of brokerage rate, which is very, very high. So all my cost, instead of being 200 ringgit, my cost is 212 ringgit. So I'm paying a very high commission for it. So they say, hey, why don't you wait until you got more money, like 1,000, only you start investing. But I said, to me, it's not so much of that commitment. Don't be so kiamsiap on that small amount, right? Okay, so what I did was every month I invest 200-300 ringgit into companies, right? I invest stocks that I like. I bought little by little, right? Although I pay high cost, I must stress I pay very high cost. But what happened was I didn't really monitor my portfolio. But what really surprises me was 2 years down the road, right? I didn't realize my portfolio was worth 18,000 ringgit. So imagine a guy that invests 200-300 ringgit a month into stock. I was able to build a portfolio of 18,000 ringgit after 2 years. So what really happened was a lot of the stocks that I invested, although 200 ringgit, although I paid 12 ringgit for that brokerage fee, right? Extra brokerage fee, I ended up making 400-500 ringgit out of it. So this is what people call as penny wise, pound foolish. So if I'm so particular about the 12 ringgit that I'm going to pay a 12 ringgit for it, I would have missed out earning 200-300 ringgit. So don't be penny wise, pound foolish. What is more important for investor is start. Don't give reason that let me wait until 10,000 ringgit, then I'll start. Let me wait until I got 100,000 ringgit, then I start. Start now. With every little money that you have, that you can afford, start little by little.
Yeah, Titan, you want to ask something this time?
Okay. Can you hear me?
Okay.
Hi.
Okay. Just to add on to the question that I asked just now is, I've been investing in many products. So stock market, unit trust, and everything, those are traditional. So the thing that I mentioned in the question just now, private equity and financial technology, I think the keyword that Peter wants to look for is the fintech. So
Yeah. Yeah,
ECF
correct.
and P2P is the fintech market is something new that the government licensed recently. And private equity is also something new that came out recently because the government is more liberal. So we are able to look into private equity, like what you say, look at the fundamental studies. And that's why we think that we invest, instead of investing in stock market where the stock market is the middleman, the fund manager is the middleman, right? There's a brokerage. We go straight to the company and we get the corporate term note and we get the preference share and stock, early stock from the company. So these are the approach that we are doing right now to invest. So it's different than what Peter mentioned just now. So that's why I was thinking like maybe Peter can give some advice on all these new things. The ECA and Funding Society, pitching, crowdfunding, all these are new way of investing instead of going through the KLSC.
I think
maybe you want to add more to this.
I said that every road leads to growth. Every road leads to growth. So there is really no good product, no bad product. There is really no good investment products or bad investment product. You see, there are people who become successful investing into properties. You can see people investing in stock market. You also can see people being successful investing in unit trusts. You can see people investing in all type of products, right? There are success stories in all products. But ultimately, as an investor, I'm back to stress on this point that if you understand what you're getting into, what are the products, the technicalities of product you invest to, then yes, you can actually minimize your risk and you can be successful. So what I'm trying to say is that the key aspect is, yes, you can invest in all these products, which is actually an alternative or even another type of investment vehicle compared to the stock market or unit trust. It's okay. But as long as you understand it, you know what it's about, then go ahead. Your risk is not about the product itself. The risk comes from your understanding of the product. If you understand the product, you minimize your risk. If you don't understand the product, you maximize your risk.
Peter, to add on, I want to throw up another question from Big Lei. She asked that what is the risk of REIT? Which REIT are recommended in Busan?
REIT. REIT, is it?
Yes, real estate.
Okay. Yes. Okay. REIT. If I use the layman term, right, REIT is actually a rental business. Mean to say, take for instance, IGP REIT, right, is technically your Mid-Valley Mega Mall. They own the mega mall and they earn the rental out of it and they pay your investors out of it. Right? So REIT is actually a property rental business. It used to be a very stable business. Okay, but then of course REIT, you must classify the type of asset. Different type of REITs have different assets. Like for instance, people like KLCC REIT, IGP REIT, the assets are actually malls, right? Retail malls assets. There are other REIT, like for instance, your Axis REIT, their assets are actually industrial properties, you need to say your factories, your commercial warehouses, whatnot. And then there are other REITs, which are actually office building REITs, right? Where actually the assets are actually coming from office rentals. So REIT is a very general concept, but it really depends on what asset they're holding to classify what kind of REITs they are. Which REIT are recommended? What are the risks of REIT? Okay, the risk of REIT is actually at this stage of time, we know that retail is not doing very well, right? So retail REITs will be coming under pressure. Office REITs also not doing well because with all this working from home, you're going to see a trend. As mentioned, what are the sustainable trends from this COVID is I think office space will shrink. People will actually encourage more work from home. So that will give some pressure to office REITs. Yeah? So what will do well? I think in this period, most REITs will be very challenging. I think the only REIT that will do well at this period is not in Malaysia. There is also another REIT called the data center REIT. It is quite famous in US. There is one or two in Singapore stock market, Singapore Stock Exchange. where the property is actually data centers, right? They actually build data center and they rent. So if you ask me, the REIT that is likely going to do well at this moment are the data centers REIT, but we don't have it in Malaysia. Or Malaysia are mainly on office building REITs and retail REITs, retail property REITs, which I think we're still going through a very challenging period.
What is your take on cryptocurrency related investment?
Oh, oh that's a very good question. It's a yes and no answer. Okay. If I have to classify my answer correctly, right? Do I think cryptocurrency is something of the future? I would say it's a yes and no. It's a yes and no. See, what is driving prices of things like your Bitcoins or your Ethereum or your Litecoins or your XRP, whatnot, right? Or Ripples, is actually supply and demand. Simply because that the supply is very restricted, there's more demand that is really driving up the share prices or the cryptocurrency prices. Okay, now, for cryptocurrency to work, you need to have a transaction value. Right? So I think this is where the challenge is. Will cryptocurrency be used as a transaction value? Okay, I give an example, right? No Fidelity, the world's largest mutual fund house, right? So this was actually 3 years ago. So 3 years ago, Fidelity actually did this experiment. In Fidelity's canteen, in their own office canteen, right? They actually allow their employees to use Bitcoin to pay for their burgers, to pay for anything, right? And then what actually happened was zero transaction was being done. Everybody still used cash. So when they try to investigate why, and the answer is actually very interesting. So imagine now, assuming that a burger costs $5, right? And now you have the option of paying $5 cash or paying $5 Bitcoin for that. And most likely, you choose to use the cash. You know why? Because your first thought will be this. If I use $5 Bitcoin to pay now, if subsequently my Bitcoin went up to $10 to $15, I'm basically paying $10 to $15 for this burger because of the volatility of the price. Because of that, you choose the option. So why I bring up this story is because, see, for things to have, okay, there's a lot of stories that saying that cryptocurrency can be used for transaction. But you must understand this. For it to be well accepted as a medium of transaction, you need price stability. You have no question of using the $5 to pay for it because $5 is $5. Tomorrow it's still going to be $5 note. 1 year later, the $5 is still going to be $5 note. But whereas if you try to use cryptocurrency, it fluctuates. So you see that there's this opposite forces that are trying to play with each other. On one hand, you want it to be a currency that is going to be used for transaction, but on the other hand, the price volatility does not allow it to be used as a currency for transaction. But on the other hand, if I have to be more accurate, do I believe in blockchain technology? I would say yes, I am a believer of blockchain technology. I think blockchain technology will be the future. So I wouldn't say cryptocurrency, but I would say that I believe in blockchain technology.
Peter, let's take 2 more questions. Anyone on the call want to raise up?
Can I ask a question?
Yeah, go ahead. Is it?
Okay.
Hi.
You get your stuff in iCapital, right? Actually, I bought some iCapital share, and the iCapital share has been stagnant for more than 15 years, right? It doesn't move much, and Kang Table keep on complaining that the valuation is not right. So what is your view about valuation? Because valuation is the one that kills investor most of the time. PE ratio is too high, or PE ratio is not realistic. So what's your value? So I'm using iCapital as an example. It's a bit sensitive to you.
It's extremely sensitive to me. That's my mentor actually. So honestly, on ethical ground, I would comment on iCapital. But I like to point out, you mentioned a very correct thing. Actually, a lot of things that actually kill investors is actually the PE valuation. Let's take a very common concept, right? Let's take all the Okay, let's think this way, right? Okay, now assuming now a stock is trading at 100 times PE, right? 100 times PE. So you believe that the share price, the earnings is going to double, that the share price fall, the earnings of the company is going to double next year. So if the earnings double, your PE will drop from 100 times to 50 times, right? Because your earnings double, and so forth, and therefore your PE will drop 100 to 50 times, right? And then you're even more aggressive. You say, okay, the year after that is also going to double in terms of profit. So again, your PE, forward PE, your future PE will drop from 50 times to 25 times, all right? Now my question to you is, what if the company did not deliver 100% growth? What if they only deliver a 50% growth? So they're still growing, yes, their earnings are still growing, and 50% is good. But what if they don't deliver the 100% that you expect it to deliver? So now you can understand why I won't name too much names. I think it's a very sensitive sector to talk about. I know a lot of people invested in this sector. If I talk anything about it, I'm going to be at risk. But I think you understand what sector I'm talking about, right? So now you understand why, despite reporting fantastic result, where it is few hundred percent growth in earnings, why the share price are not moving. That will actually give a very good idea about, because ask yourself this: do you think this 300-400% growth in profit, is it sustainable? If it's not sustainable, do you want to pay the current PE for it? So you're right. PE is actually one of the valuation is a very common factor that actually kills investors.
Right. Take one more question.
I have one question. Can I ask?
Go ahead.
Okay, so I'm just trying to understand, right? I believe fundamental, usually people are more towards dividend investment, right? So what's your take on growth investment? Will you be interested in companies that have future, but the earnings right now is like negative? What's your take on that?
Okay, that's a good point. Okay, I need to clarify that fundamental investment is not about dividend investment. Wait, fundamental investment is fundamental analytics. Let me be more specific. It's about the strategy. Fundamental analysis simply means to say, before you invest in any company, you make sure that you understand the business. What is the fundamental of the business? What the company is all about? Actually, that's what we call it fundamental analysis. Mean to say, you must understand the fundamentals of the business before you invest. Okay, that's what actually means by fundamental analysis. Now, when it comes to investment strategy, there is a dividend strategy, there's a growth strategy, there's so on and so forth strategy. Right? Honestly, I am a very neutral on strategy. To me, I am not defined by strategy, because it can be overlapping. Okay, all these concepts are created by authors or writers or investment gurus. Although you know there's a good intention, but it tends to result in more confusion among investors. So my advice to investors is, as long as you think that it's a good company, that you think that the prospect is good, you're not overpaying for it, it's a good time to pay. Okay, now, what is the pitfall? Let's take your dividend investment strategy. The biggest pitfall is that investors don't understand dividends are not guaranteed. Okay, now, say for instance, you say, okay, I'm investing in this dividend. The dividend yield is say 6% dividend yield. Means for every 1 ringgit, this company give me 6 cents dividend. But don't forget that 6 cents dividend is a historical data. It's based on last year payment. Unless the company guaranteed written black and white, every year I will pay you 6 cents good times or bad times. Then you can say I'm using a dividend strategy. But like it or not, no company will promise or commit dividend. So whatever high dividend yield that you're looking at now is based on historical payment, which is not guaranteed. A very good example. This year, COVID strike, do you notice all companies which historically have been paying good dividends have actually either stopped paying dividend for the moment or cut their dividend? So you see, that means the dividend yield strategy doesn't work. Okay. Growth stocks are companies that can grow very fast or good growth in earnings over the next few years. Okay. That's come to turn around. When you mention the company that actually has negative, but you're betting on to go positive, or there's a chance for it to return to positive, right? We call that as a turnaround investment. Yes, I do admit turnaround investments are the best category to earn big returns, but it also comes with the highest risk in the sense how it really need to depend on how confident you are or how much you know about the industry and the business that you're so sure that it's going to turn around. If you have that understanding that you know very well, okay, I know this industry very well, I know this business very well, you're very sure that this is going to turn around or the worst is over, then yes, it's actually a very good investment strategy to use. But again, no, as I think Murphy's Law, anything that can go wrong will go wrong subsequently. So although it also gives the best return characteristics, but it also gives the highest risk characteristics because things may go wrong. Because there's no historical earnings to support that analysis. I hope I answered you, Wei Feng.
Okay, thank you. Thanks.
Peter, I want to thank you again to spend your time this morning together with us, despite you was busy in the school learning the early when I texted you. Right. For those that wanted to know more, I will encourage you to buy Peter's book. Right. What I learned as an analyst. One thing that amazed me when I read this book is that 100% of the profit from this book actually go to charitable organization. Correct me if I'm wrong, Peter. Or I think none of that goes to Peter's pocket. Every single cent that you spend on this book will go to charitable organization that Peter been very diligently supporting. So feel free to read this book. Free to your children if you have, because it will help them to understand a bit on these very, very fundamental things about finance and how you evaluate a company. And Peter, before we go, I want to ask this: if people wanted to know more about you, learn more about you, where can people come and find you? If you cannot, follow in some sense, and if this resonates to the audience of the book club.
Okay, at the moment I only have Facebook page, which is Peter Lim TC, T and C, chain. So it's Peter Lim TC. That's my Facebook page. Actually, at the moment, I also engage with a very good friend of mine to help me with creating my own website. It's still a work in progress. So of course, definitely once it's up, I'll actually announce it in my Facebook. So the only media I'm using now, being an old guy, I only know how to use Facebook. I don't know how to use Instagram. I'm quite bad with all other type of social medias. So there's only Facebook, which is Peter Lim PC. Yeah. Right. If you see a bald guy on the face, I think technically that's me. There's not many bald guys out there. So.
All right, Peter, thanks for your time, and thanks for the rest of the folks that stayed throughout this 1.5 hours together with us. And I hope you learn something new. And happy investing, and don't be a bad investor. Thank you
very much. Thank you.
Bye.
Alright, this is all that we have for today. I hope that you gain some different perspective and experience from Peter Lim. And if you like us, do remember not to forget to like us and subscribe to this YouTube channel. And I wanted to bring you more value, which you would appreciate. And I want you to get the latest information when we have another video posted up in the future. And nonetheless, do leave your comment below. If you have something that you wanted to ask and you have some feedback that you wanted to give to me. Alright, thank you again, and I will see you next time. Bye bye.